Recall in chapter 2, we said that direct finance and indirect finance. Indirect finance is much more important than direct finance. That is, when borrowers want to borrow money from the lenders, usually the lenders don't lend money directly to the borrowers. The borrowers do not usually borrow money from the lenders directly. Instead, they go through a financial intermediary. That is, the lenders lend money to the financial intermediary, and then borrowers borrow money from the financial intermediaries. Why? Why is that the case? Now we are going to use chapter 8 to explain why the indirect finance is much more important than direct finance. First, let me ask you a very simple, basic question. Why would a market fail? Well, what are the two necessary components in a market? The answer is demand and supply. So, how can a market fail? How can a market crash? The answer is, first, there is a demand, but there is no supply. That is, suppliers withdraw from the market. The second one is, there is a supply, but there is no demand. That is, all the demanders withdraw from the market. Then in those cases, a market will fail. Now the second question is, I just add one word. How can a financial market fail? Are the answers the same? One, there are fund suppliers, but no fund demanders. Two, there are fund demanders, but no fund suppliers. Is that the case? The answer is not necessary. No. Why? Because financial market is special. Think about this case. There are fund suppliers, but no fund demanders. Is it really possible in the financial market? First, financial market is to transfer funds from the lenders to the borrowers. And the borrowers is going to use the lender's money to do something, to do investment. Okay, so whose money is it? Fund demanders' money or fund suppliers' money? The answer is it's fund suppliers' money. Who are going to use this money? The answer is fund demander. So the fund demander is using fund suppliers' money. Is it possible for all the fund demanders to withdraw from the market? No. Why? Because fund demanders are using other people's money. Why would they withdraw? It's not their money. So how can a financial market fail? The answer is there's always fund demander. But fund suppliers withdraw from the market. And fund suppliers have all the reasons to withdraw from the market. Why? Because that's their money. And they are not using the money. It is the fund demanders who want to use the money. So this case will not happen. There are always fund demanders, say gamblers. They can use your money and do whatever they want. So they always demand money. So how can the financial market fail? The answer is fund suppliers withdraw from the money, and they have all the reasons to withdraw from the money because they are not the one who used the money. It is the fund demanders who used the money. So there are two factors that cause financial market to fail. That is, there are two factors that cause fund suppliers to withdraw from the market. The first one is transaction cost. Say, for example, you have $100 and you want to buy Microsoft. That is, you want to lend your money to Microsoft. But Microsoft stock price, say for example, is $90. But when you go to TD Ameritrade, Scottrade, they charge you $9 to buy this Microsoft stock. Are you going to buy it? No, you should not buy it. Why? Because you lose 9% right away when you buy this stock because of this transaction cost, this trading fee. So you will not buy this Microsoft stock when you have $100 because you lose 9% right away. Therefore, you are not willing to lend $100 to Microsoft because of transaction cost. The second factor that causes financial market to fail, that is, the second factor that causes fund suppliers to withdraw the market, is called asymmetric information. What is asymmetric information? Based on what you have learned in 4th grade. What is asymmetric? This is asymmetric. They are not the same. So this is information set 1, information set 2. These two information sets are different. That is called asymmetric information. One is the information set of the borrowers. The other one is the information set of the lenders. Okay, which information set is the lender's information set? And which one is the borrower's information set? That is, who has more information than the other? The lenders or the borrowers? The answer is the borrowers. Borrowers have more information than the lenders. Why? Because borrowers are the ones who are using the money to do investment. They know what they are going to do. Lenders has less information than the borrowers because they don't know what borrowers are going to do with their money. So this is the key. Whose money is it? Lender's money. Who is using the money? Borrowers. Who has more information? Borrowers. Therefore, because of this asymmetric information, lenders, because they have less information than the borrowers, they may not want to lend money to the borrowers. Therefore, they withdraw from the market. That causes financial market to fail. This is called the asymmetric information problem. Asymmetric information causes two problems. The first one is called adverse selection problem. The second one is called the moral hazard problem. Let me talk about these two problems one by one. So what is an adverse selection problem? Let me give you an example from the used car market. Say for example, person A has a used car. He has a good used car. And B has a lemon car. Not so good. Alright? So A's car has a true value of $500. B's used car is a lemon car. Lemon car has its value, okay? The value is not zero. You can still drive the lemon car, but it is not as good as the good used car. So the value of the lemon car is, say, for example, $300. Now, you want to buy a good used car. You want to buy a used car. So you go to A and ask A, is your car a good used car or a lemon car? What is A going to tell you? Of course, A will say, my car is a good used car. If you go to B and ask B, is your car a good used car or lemon car? What is B going to say? The answer is, B is going to lie. He is going to tell you that his car is a good used car. This is where the asymmetric information is. The car owners have more information than the car buyers. You don't know whether the cars are used cars or good used cars or lemon cars. Only the owners of the cars know. Alright? Then how much money are you going to offer to buy a used car, both to A and to B? The answer is, you don't know which car is a good used car, which car is a lemon car. Therefore, the chance that you get a good used car is 50%. And the chance that you are going to get a lemon car is another 50%. Therefore, you are going to pay the expected value of the car that you are seeing. So 50% of the chance you are going to get a used car, good used car. 50% of the chance you're going to get a lemon car. So the expected value of the car that you are seeing is $400. Therefore, you are going to offer $400 to buy a used car. Now the problem is A going to sell you his car? The answer is no, because his car has a value of $500. And he knows that car buyers do not know whether cars are good or bad. Therefore, everybody knows that car buyers are going to offer $400. Therefore, A is going to withdraw from the used car market because nobody will pay him $500. People will pay him $400. The only ones that are left in the market are lemon car owners, because they are willing to sell their car. They are happy to sell their car for $400 because the true value of their car is only $300. Therefore, before the car buyers goes to the used car market, before the car sellers go to the used car market, everybody knows that the offer price of an used car is $400. And there will be no good used cars on the market because all the good used car owners will withdraw from the market. Therefore, the only cars that are left in the used car market are overvalued lemon cars. Their values is $300 and people are going to pay $400 to buy this car. Therefore, buyers are not going to buy a car because all the cars they are seeing are lemon cars. Therefore, used car market crashes. This is called adverse selection. You always select the bad cars because the only cars left in the market are bad used cars. So this is the adverse selection problem of the lemon car market. Therefore, let me define the adverse selection problem again. Adverse selection problem happens before transaction even occurs. That is, before you buy the used car, before used car sellers sell a used car. Because the potential borrowers, the potential buyers of the used car are going to get the adverse outcome. That is, they are going to select the worst cars. Okay? This is called the adverse selection problem in the used car market. Then in the financial market, what is the example? Let me give you this example. A is an entrepreneur. B is a gambler. So you have money. And then A has an investment opportunity of earning 6%. B, the gambler, is going to get your money and go to Vegas and leave everything in Vegas. Now, they know that you have money. A said that I'm going to offer you 3%. What would B say? B say, I'll offer you 4%. Then A would say, okay, I'll offer you 5%. I can still earn 1%. But B will say, okay, I'll offer you 6%. Is A going to offer you 7%? The answer is no, because A can only earn 6%. Therefore, A and B and you, everybody knows that A cannot beat B in offering a higher interest rate, because B is going to offer a higher interest rate. They are going to take the money, they are going to Vegas, they are going to waste your money and run away. Therefore, the only borrowers left in the market are the gamblers. Potential borrowers, the gamblers, most likely to produce adverse outcomes, take your money to Vegas and run away, are the ones most likely to seek loans. And they will be selected because they are the ones that can offer the highest interest rates. That is called the adverse selection problem in the financial market. That gives you a very important thing to know. That is higher interest rate a good thing for the economy? The answer is no. When you see interest rate becomes very high in the market, what does that mean? Who bid up the interest rate? The answer is the gambler. Because the entrepreneur will not be able to offer a very high interest rate, because you rarely see a very high return opportunity. Okay, so most likely when the market interest rate is high, that means there are a lot of gamblers on the market. That is, you should not go to the financial market to lend out your money. Instead of trying to earn a very high interest rate, you better keep your money underneath your bed. 0% is much better than negative 100%. This is called the adverse selection problem. The second problem caused by asymmetric information is called moral hazard problem. Again, let me use the professional athlete market to explain what a moral hazard problem is. Say, for example, you are drafted number 2 in the NBA. You sign a contract. You get the money. And then you ride a motorcycle, and then crashed, and never played again in the NBA. Okay? A is the athlete. B is the owner of the teams. When you are signing an NBA contract, what are the two most important things that you want to negotiate? Same thing. If you own an NBA franchise and you want to negotiate a contract with the player, what are the two most important things that you want to negotiate? The first one is the terms of the contract. The athlete wants a long term to protect them. The owners wants a short term because they don't know whether the athlete will last that long. The second one is signing bonus. Because what is a signing bonus? Signing bonus is you get the money right away. So athlete wants the big signing bonus. The team owner, no. As little as possible. Alright, now A and B sign the contracts. After A, the athlete gets the money, he has the incentive to do things that the team owner did not want him to do when they are signing the contracts. That is, riding a motorcycle. That is an example of moral hazard in the professional athlete market. So what is a moral hazard problem? The answer is, it's after transaction occurs, after they sign the contract. Okay, remember, the adverse selection is before transaction occurs. Moral hazard problem happens after transaction occurs, after they sign the contract. Athletes have the incentive to do things that the team owners do not want them to do. This is called moral hazard problem in the professional athlete market. Then what is the moral hazard in the financial market? Say for example, in our previous example, A, the entrepreneur, somehow solve the adverse selection problem, and you lend your money to A, who can earn 6% return. So he is going to open an ice cream shop. So he takes your money and then drive on the highway trying to buy some machines to open an ice cream shop. So after transaction occurs, he gets your money. And when he's driving on the highway, he sees some billboard along the highway. Mega Lotto, $300 million. He keeps driving. Mega Million, $300 million. Mega Million, $300 million. Then he takes an exit. Go to the gas station. Use your money to buy Lotto tickets. That is, after he gets his money, he cannot resist the $300 million Lotto prize. Therefore, he has the incentive to use your money that you did not want him to do when you signed the contract, when you lend him the money. This is called the moral hazard problem in the financial market. So again, two factors that cause financial market to fail, that is, two factors that cause the fund suppliers to withdraw the fund from the market are transaction cost and asymmetric information. And asymmetric information causes adverse selection problem and the moral hazard problem. So how can we solve these problems to prevent the financial market from failing? First, let's see how can we solve the transaction cost problem. Remember the example I used? You have $100, you want to buy Microsoft, the transaction fee is $9. You're not going to buy it, right? But, say for example, we have 100 students in the class, so I tell you that, okay, everybody put your $100 on the table. I'll collect these $100. So 100 people, I will have $10,000. Then I will use these $10,000 to buy Microsoft stocks. How much transaction fees am I going to pay? $9. And I will charge each one of you $1 to buy Microsoft. Now you have $100 and you spend $1 in transaction fee, you lose 1% right away. Well, you may want to do the stocks. And I earn $100 from you, and then I only pay $9 to buy Microsoft stocks for you. So I earned $91. I'm happy, very happy. You're happy because you buy Microsoft stocks and you only pay $1. So who am I? I'm called the mutual funds. I'm the mutual fund company. So this is what the mutual fund company do. They use economies of scales. So people use mutual fund company, a financial intermediary. They deposit money into the mutual fund company, and then the mutual fund company buys stocks for those people, for those depositors. They use the economies of scale. And you want to put your money in the mutual fund because mutual fund has the ability to do the analysis on Microsoft stocks because they have a lot of money from the investors. Therefore, they can build their expertise. Therefore, the mutual fund company is the solution to reduce the transaction cost. Therefore, investors are willing to lend money, buying stocks, buying bonds from the companies. They are willing to lend money to the companies. The second one is the asymmetric information problem. And the asymmetric information will cause adverse selection and moral hazard problem. Now, how can we solve the asymmetric information problem? First, let's talk about how we can solve the first problem, adverse selection problem that is caused by asymmetric information. Remember the example that we used for adverse selection problem? The used car market. Alright, now how can we solve the lemon car problem, the adverse selection problem in the used car market? Well, you can hire. Remember, A has a car of $500, B has a lemon car of $300. Now you can hire a private technician, and you take this technician to A and B and examine the car. And you pay $50 to the technician. And the technician tells you that, okay, A's car is a good used car, B's car is a lemon car. Therefore, you should pay $500 to buy A's car and $300 to buy B's car. So if you buy A's car, you pay $550. If you buy B's car, you pay $350. It's better than you pay $400 to buy the $300 lemon car. Therefore, you are willing to hire a technician to produce private information. But the problem is, when you called A saying that you want to pay $500 to pay his car, and when you called B and saying that you want to pay $300 to buy his car, your roommate heard your conversation. So your roommate knows that A has a good used car and B has a lemon car. Then he will call A saying that I'm offering you $510 to buy your car. Or call B saying that I'm offering you $310 to buy your car. The results? Who is going to get the car? You or your roommates? The answer is your roommate, because your roommate offered a price that is higher than what you offered. So it is your roommate who gets the car, not you who gets the car. The result, you lose $50 for nothing. We give a special name to your roommate. Bastards? No. We call him free rider. So because the free rider problem, you know that there exists a free rider problem. Therefore, you are not willing to hire a technician to waste your money. Therefore, you withdraw from the used car market. Market crashes. Have you ever heard about free rider problem? Probably yes, in your microeconomics. What is another very famous example of the free rider problem? The answer is in public finance. The free rider problem can be found in the neighborhood parks. Okay? The neighborhood wants to build a park. So they ask every household in the neighborhood to donate. But the problem is, if you donate, there's a park. You can get into the park. But if you don't donate, and the park is still built, you still can go to the neighborhood park because you don't have to buy a ticket. Therefore, if you don't donate, you are called free riders. You can enjoy the park without donating money. What is the problem? The problem is everybody wants to be a free rider. Therefore, nobody donates. Therefore, there is no neighborhood park. So what's the solution of the free rider problems in the neighborhood park? The answer is we can ask the government to tax the households in the neighborhood and then use the tax money to build the neighborhood park. So the way to solve the free rider problem is for the government to get into it and use government regulation to increase information, because this is a asymmetric information problem, right? To solve the free rider problem. So in the financial market, government will put some regulations on the companies, ask them to reveal the company information to the investors so that, remember the information, asymmetric information problem, the government is going to ask the company to reveal their information to the lenders so that lenders will have the same information as the borrowers. Therefore, government regulation can increase information of the lenders to solve the asymmetric information problem. But in a country like the United States, business hates government regulations, and government needs business to get the campaign money to run for the next term. Therefore, government regulations are not going to work very well in the United States. So how can we solve the adverse selection problem? The answer is the financial intermediaries come to the rescue. Alright? So the role of the financial intermediaries in solving the adverse selection problem in the financial market is similar to the role of the used car dealer in solving the lemon car problems. So you don't buy used cars directly from the used car owner. Instead, you use a used car dealer. They have the expertise, they can hire the technician and analyze the car seller's car, whether they are good used cars or lemon cars. So they can also avoid the free rider problems because they have the private information of the cars. Financial intermediaries can make private loans instead of buying securities in the security market. If you have ever borrowed a mortgage, you will know this private information. If you want to apply for a mortgage, you will have to provide all kinds of information to the bank. Say, for example, you will have to provide your pay stub, your proof of employment, your last 3 year 1040, Form 1040, your 3 months bank statements, your social security numbers. You don't provide those information to everybody. But if you want to apply for a mortgage, the mortgage company will get all this information from you so that they have the private information about you. So they make you a mortgage. It's a private loan. Only they know your information so that they can avoid the free rider problem. Nobody else knows your information. Okay? By doing that, the financial intermediaries can solve the adverse selection problem. The fourth solution is collateral. Say, for example, if you want to borrow a mortgage, what is your collateral? The answer is the house deed. If you want to borrow a car loan, what is your collateral? The answer is the car title. Right? You don't keep the title. The bank who makes you a car loan keeps the title. It's their car. It's not your car if you borrow money from them to buy the car. Another one is net worth. What is net worth? Okay, let's use accounting 101. So on the left side is the assets. On the right hand side is the liabilities. You borrow money, that's your liability, to buy assets. But there is another part on the liability side. Okay, what is this? This is called equity. Why? Because remember, on the liability side is the resources of funding, right? You borrow money, but you can also issue stocks. When you issue stocks, you don't owe people money. Alright? Another item on this part is called retained earnings. That is, say for example, the company earns $100. They want to use this $100 to buy $100 of assets, say for example, a computer. Do they owe people $100 more? No, they earn $100, so this $100 cannot be in liability. You have $100 on the assets side, you must have $100 on the liability side. Where do you put it? If you cannot put it here, you put it here. So this part is called net worth, which includes equity and retained earnings. So why is it called net worth? Net worth is, say for example, if you go bankrupt, you sell all your assets to pay off your liability, what's left is called net worth. So what is net worth? You sell all your assets, pay off your liabilities, what's left is the net worth of the company that can be distributed to the company owners, the stockholders. This is called net worth. So what does that mean? That means if this part is bigger, that means even if you go bankrupt, you still have this amount of money to pay the stockholders. Therefore, stockholders are more willing to buy your stocks. Therefore, in order to avoid the adverse selection problem and give the lenders the incentive to lend you the money, you keep a bigger net worth. That's also a solution to the adverse selection problem.